How is debt-to-income ratio T calculated for a home? Imagine trying to figure out if you can comfortably afford a new home. One key number that helps with that is your debt-to-income ratio. This ratio shows how much of your income goes toward paying debts each month. To find it, you start by adding up all your monthly debt payments. That includes your mortgage or rent, auto loans, student loans, credit card minimum payments, and any other regular debts. Next, you look at your gross monthly income, which is your income before taxes and deductions. Then, you divide your total monthly debt payments by your gross monthly income. For example, if your total monthly debts are $2,000 and your gross income is $5,000, you divide 2,000 by 5,000. That gives you 0.4 or 40% when you convert it into a percentage. There are two main types of debt-to-income ratios used in home buying. The first is called the front-end ratio. This only looks at housing costs, including your proposed mortgage payment, property taxes, homeowner's insurance, and any homeowners association fees. To calculate it, add up all these housing expenses and divide by your gross monthly income. The second is the back-end ratio. This includes all your monthly debts, not just housing. So you add your mortgage or rent, auto loans, student loans, credit cards, and any other debts. Then divide that total by your gross income. Let's say your gross monthly income is $5,000. Your proposed mortgage payment is $1,800. Your property taxes are $300, homeowner's insurance is $150, and homeowners association fees are $50. Your total housing costs are around $2,300. To get your front-end ratio, you divide 2,300 by 5,000, which equals 0.46 or 46%. For your back-end ratio, if your other debts total $2,000, then you add that to your housing costs, making it $4,300. Divide that by $5,000, and you get 0.86 or 86%. Lenders look at these ratios to see if you can handle monthly payments comfortably. Usually, they prefer the back-end ratio to be 45% or less. If your ratios are too high, it might be harder to get approved for a loan. For real estate investors, understanding your debt-to-income ratio helps you know how much financing you can qualify for. A lower ratio means you might get better loan terms and more borrowing power. When interest rates go up, your monthly payments can increase, which might raise your debt-to-income ratio and affect how much you can borrow. So, to sum it up, calculating your debt-to-income ratio is simple. List all your monthly debt payments, find your gross monthly income, divide the debts by the income, and then turn that into a percentage. This number helps you understand if you're ready to buy a home or if you might need to pay down some debts first. It's a handy tool for both home buyers and real estate investors to keep their finances in check.